this is Brian Rezny, president of Rezny Wealth Management. We've got a great show for you today. We're going to talk not only a lot about the investment markets and the economy, but we're also going to talk about the biggest single risk investors face, which is not understanding fiduciary versus suitability. Is your money really being managed? Is the firm you entrust your life savings and your retirement actually managing your money? And do they have to put your legal best interest ahead of theirs? What you're going to often find out is most investors truly don't understand the difference between a fiduciary advisor and suitability. This major risk will devastate your portfolio, provide mediocre returns, high expenses if you don't truly understand the firm you entrust your money. And the big fact is, do not falsely believe just because the firm you entrust is a big Wall Street firm, banker, insurance company, because these are the biggest crooks in the industry. Most investors don't realize how many times most of these firms have been fined and censured, not only by FINRA, but by the SEC. And most of these firms often work under what's called suitability, meaning your interests are put at the end of the line. Suitability versus fiduciary. Do you know the difference? I'm going to ask you to go to my website at reznywealth.com and you can download for free our fiduciary versus suitability questionnaire. Fee only versus fee based and commission. Again, another crux of the problem. We're going to talk a lot about this so you, the investor, understand where the advice you're getting, is it real advice or is it really just sales in order for that Wall Street firm, that bank, or that insurance company to profit off your life savings and your retirement? Why is there so much confusion when it's revolved around these two ways of representing a client? It's on purpose. The bottom line is this: Wall Street banks and insurance companies do not want you, the investor, to understand that often, and most often, they don't work in your legal best interest and they can downright work against you and your money. There's two terms in the industry. It's called a suitability standard of care and a fiduciary standard of care. And after today's program, you're truly going to understand the difference. Sometimes you've probably wondered, is the advice I'm getting really working? Is that person really supposed to give me the best advice? And how do I get the best advice that's in my legal best interest? Would you, as an investor, work with any investment firm who did not have to work in your legal best interest 100% of the time? The sad fact is, most investors are not working with a fiduciary, a fee-only fiduciary, which does have a legal obligation to work in your best interest 100% of the time. Most of you are working under what's called suitability. Sad fact, 90% of you listening right now are working with a firm who does not manage your money and does not work in your legal best interest. I know what you're saying. My person's a nice person. She or he calls me on a regular basis. That doesn't mean that they're managing your money. What it basically means is you maybe don't understand the relationship you have. 90% of investors are working under what's called either a fee-based or commission-based account, and often under what's called suitability standard of care. There is a big difference between a fee-only money manager working fiduciary standard of care versus a fee-based or commission-based firm or advisor. Your single biggest risk as an investor is to falsely believe all investment firms and advisors have a legal obligation to work in your best interest as a fiduciary advisory firm. Fiduciary standard of care simply means this: doing what is legally in the best interest of the client, namely always putting the client's interest ahead of the firm and the advisor. At the end of the day, most investors, again, are working under what's called suitability. What suitability essentially means is this: that firm or advisor only has to sell you investments that are suitable based upon your age and your goals and objectives. They don't have to be the cheapest or the best. Often they're the more expensive and inferior investments that have poor performance and high expenses. As long as they've sold you investments that are suitable based upon your age and your goals and objectives, suitability has been met. That doesn't cut it in the fiduciary standard of care. Working with a firm like Rezny Wealth Management, which is a true fiduciary, 100% fee only and a money management firm, we always have to use investment strategies, products, and investments that are in the best interest, cheaper, better for the client. Not suitable for the client, better for their objectives and their goals. So as an example, most investors that might buy a mutual fund are sold a mutual fund through their broker or so-called advisor. That mutual fund might be, let's say, a small cap growth mutual fund with an expense ratio of 2% annually and a very mediocre performance. Suitability's been met. Under fiduciary, a firm like ours would use something like an ETF, where instead of a 2% annual expense ratio, maybe the expense ratio is 20 basis points or less than 0.25% or 1/8 of the annual cost, and a much better performance. Suitable is one thing, fiduciary is completely different. Suitability standard of care, an advisor or firm only needs to suggest, again, products that are suitable based upon your objectives, income level, and your age. That's it. They don't have to be good. They don't have to be cheap. They just have to be within your goals and objectives and your age. And again, suitability's been met. It's legal for your broker and their firm to put their interest ahead of yours under suitability. Remember, the vast majority of people, in fact about 90% of you right now listening to our program, you're probably working with a fee-based or a commission-based advisor, and more often you're working in a commission structure under suitability. That firm does not have to put your legal best interest first. In fact, you're at the end of the line. Let's put it a different way. You show up to the grocery store. You decide you want to buy a loaf of bread. You're suitable to buy a loaf of bread because you're going to make a sandwich. In the bread store in aisle 1, there's the loaf of bread that you see. That's $3 a loaf, and it's clearly moldy. On the other side of the aisle, here's a wholesome loaf of bread just off the bread truck. It costs $1.50. Fiduciary standard of care would mean a firm like Rezny Wealth Management would have to use the $1.50 wholesome loaf of bread because clearly that's legally in your best interest. Under suitability, your Wall Street firm, your broker, the bank, the insurance company, working under suitability can sell you the moldy $3 loaf of bread because, again, you're suitable to buy bread because you want to make a sandwich. That's basically the difference between suitability and fiduciary. One's in your legal best interest, the other one works against you and your money, but unfortunately, too many investors don't do proper research and they falsely believe that their nice advisor, so-called advisor or broker, is actually looking out for their money. Do you understand the difference between an advisory account and a brokerage account? Simply put, a brokerage account is not managed money. An advisory account is managed money. Again, about 90% of the individuals that come into our offices at Rezny Wealth Management are working under suitability, and they have a brokerage account. But they almost all tell us, I thought that person was watching my money. I thought they were managing my money, but they never called. I thought they had to work in my legal best interest, but after listening to your TV and radio show and doing a little bit of research off your website, Brian, we now realize that the person was a nice person, but they were working against our money and our retirement. Read this disclaimer and you decide if this is the kind of firm you want to entrust your money. By the way, this disclaimer or something very similar shows up on all the brokerage new account applications that you, the investor, signed. It basically states you have a brokerage account, not an advisory account, that their interests are different than yours. And it also talks about conflicts of interest And do they actually have to disclose those conflicts of interest or work in your best interest? The bottom line is this. If you have a brokerage account that's not managed money, it's under suitability, and that broker, so-called advisor with the fancy title of wealth manager, financial planner, vice president, is clearly not managing your money and not working in your best interest. When you have a brokerage account, not an advisory account, you, the investor, are responsible. What do I mean by that? Most people think the broker or advisor is going to call them and say, you need to sell. We're headed for a recession. Not going to happen. At the end of the day, when you have a brokerage account, you, the investor, are responsible to manage your own money, do your own research, call your own shots, develop your own investment strategy. Your broker or so-called advisor with that fancy fake title does not manage your money and is not responsible to watch and babysit your money. Unfortunately, this is a big crux of the investment problem for you retirees and pre-retirees, because nobody's really watching the money because you thought Mr. Broker or Advisor was doing it when they clearly do not have a legal obligation to do so, because you did not have an advisory account, you had a brokerage account. My advisor never called. They're not going to call because, again, if you're not in an advisory account, in an investment advisor agreement, then you don't have an investment advisory account and your money's actually not being managed. You're actually being sold or recommended investments that you thought were properly researched, but these were proprietary product sales by your brokerage firm, bank, or insurance company. Wall Street's basic agenda is to manufacture investment products that are better for them than for your portfolio. What does that mean? It's simple. All brokerage firms, insurance companies, and banks manufacture products like annuities, mutual funds, structured products, non-publicly traded REITs. Their job is not to work in your best interest. Their job is to make their shareholders money, which is not you. So at the end of the day, what you need to understand is this. All those crazy products that show up in your portfolio, like A, B, and C class share mutual funds with commission, is under suitability. Variable annuities are under suitability. Structured products are under suitability. Non-traded REITs, again, under suitability. Fixed equity index annuities, again, under suitability. Any commission-based product is under suitability. At the end of the day, you, the investor, needs to understand, is that broker, that advisor, is it fee only, or are they fee-based and commission? Remember, fee only is what you want, not fee-based and not commission, and you never want to work under suitability, you never want to work with a firm that earns commissions, and you never want to work with a firm that doesn't legally work in your best interest 100% of the time. I'm going to take a short break. I'll be back with some of your questions. Please visit my website, reznywealth.com, and for free, you can download our fiduciary versus suitability questionnaire if you want to truly understand more how to protect your wealth. Download our free report, Fiduciary versus Suitability. It's available for free on our website. It is your number one risk, and you falsely believing that the firm you entrust with your money is actually managing or working in your best interest, I'd rather have you know for sure than lose out during retirement. I'll be right back. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Every single week I receive dozens of phone calls on my TV and radio show from disgruntled investors who were sold an annuity that didn't belong in their portfolio. Don't let your retirement be taken to the woodshed. Read my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Go to reznywealth.com right now. And we're back. We're talking a lot today about fiduciary versus suitability, real money management or a sales job. It's sad, but every single day in our offices in Naples, Fort Myers, Boca Raton, or Coral Gables, Not only do we see individuals, but we talk to so many people on my TV and my radio shows that really didn't understand the difference between fiduciary versus suitability. You, the investor, need to take some action, and you need to do just a little bit of research. There are real firms out there that really manage your money. Firms like Rezny Wealth Management that are fee only in a money manager capacity. The problem is investors entrust their money to a family member. They get a referral from somebody who is not fee only. They hear these warm and fuzzy commercials from these brokerage houses, how they're your trusted advisor. The bottom line, nobody should ever be trusted unless they're fee only and they work in a 100% fiduciary capacity. Remember, suitability, those firms can work against you and your money, high cost, not money managed. Under fiduciary, fee only, works in your legal best interest and actually manages your money. So if you've ever wondered why you never got that phone call and you're always told, hold on, things will come back, I can pretty much guarantee you're probably working with either a fee-based, commission-based advisor, and you're probably more apt, you're probably really working under what's called suitability. Your money's never been managed, and unfortunately that affects your return, and it's going to hurt your retirement. Fee-based is not the same as a fee-only advisor. A lot of these brokerage firms, banks, and insurance companies now want to add fee-based to their name. Again, fee only is what you want, not fee-based. Again, Wall Street and these banks and insurance companies don't want to explain what our firm has explained for years. The reason they don't want you to understand the conflicts and the high cost working with them. Go to the sec.gov or finra.org. Go to the newsroom or the search on the top of those web pages. Type in the name of the firm that you entrust your money to. See how many times they've been fined or censured. Probably hundreds or even thousands of times. Would you work with a firm that's been fined thousands of times? Have you actually ever gone to the sec.gov or finra.org and actually looked up your advisor or firm to see what they've done to their clients and should they really be your trusted advisor? A fee-based financial advisor can receive commissions and fees from you, paid by their brokerage firm, mutual fund company, insurance company, and investment partnerships. The bottom line is this: when you're working with a fee-based firm, like all these Wall Street firms, insurance companies, and banks, they can still sell you their manufactured products or preferred sponsorships. They can still receive commissions, 12B1 fees, revenue sharing. All these things come against you and your money. What you want to do as an investor is hire a firm that's actually managing your money and eliminate all of that high cost and those conflicts of Wall Street or so-called advisors. They might be nice people, but at the end of the day, if they don't manage your money and they're not working in your best interest, are you going to put your retirement at jeopardy? Ask yourself that question. Check out your advisor or brokerage firm. Go to finra.org or sec.gov. Either one of these websites work great. We're going to leave it up for a couple minutes so you can write this down. But go to finra.org. Again, at the top of their website, you can type in your firm name and find out how many times they've actually been fined or censured. Again, most of these firms, hundreds if not thousands of times. Go to sec.gov. Again, check out the firm you entrust your money. Why would you ever entrust your money to a firm if you haven't checked them out and if they've been fined for misdoings against you or clients just like you? Investors should get the answers and get the right answers. Go to my website, Fiduciary versus Suitability. We have our free questionnaire available on my website at reznywealth.com. This questionnaire will save you from the salesperson, banks, insurance companies, and Wall Street. You'll know the right questions to ask when you interview a firm. If you're currently using somebody and you have doubts about their ability or if they're actually managing your money, go to my website. It's free. Download that questionnaire. Ask your current advisor the questions on that questionnaire, but make sure you have them sign it. This way, if they lie to you, which often will happen, you'll have it in writing. You'll know if they're fee-based, commission, or if they're really a fee-only firm, and if they actually manage your money based upon your goals and objectives. It also will talk about the differences between fee-based and fee-only on that questionnaire. We've had so many great compliments at our firm about our questionnaire that you can use for free. It can really save your portfolio and save your retirement from Wall Street charlatans, the annuity charlatans, and people who have no objective but to earn a commission off your retirement. William in Fort Myers, Florida. I'm 68 years old. The firm I'm working with suggested I liquidate my variable annuity for a security benefit equity index annuity. My advisor says it has a better chance to grow. What do you think? William, great question. First off, you are clearly not working with a fee-only fiduciary money management firm. Your person is a broker with a fancy title. That's number one. Number two, he clearly sold you a variable annuity before. Now he wants to do a transfer into an equity index annuity. You want to avoid all annuities, bottom line, whether it's variable or equity index annuities. Annuities in general are the most toxic and the most expense-ridden investments there are in the investment arena. Make sure you understand what you're getting yourself into. The only reason your so-called advisor wants you to go from a variable annuity into this equity index annuity is to earn more commissions. Bottom line, that variable annuity has a better chance to actually grow more than the equity index annuity does. But the expenses on both of these are crazy and the returns will be mediocre. If you look at the expense ratio on either one of those products, you want to look at what's the opportunity and what's the cost. The average variable annuity I look at, and often the average equity index I look at, has annual expense ratios well over 4% every single year. So before you put your hard-earned money to work, make sure you understand you're getting your retirement taken to the woodshed if you continue to own that variable annuity or if you buy an equity index annuity. People that sell annuities for commission, which is those are clearly commission products, work under suitability. They don't manage your money, and they're not working in your best interest. I would also suggest you go to my website, reznywealth.com. For free, you can download my special report, Why Annuities Are Dangerous to Your Wealth and Your Retirement. It's free on my website. Go there right now, download it. Read more about annuities. We talk about these equity index annuities. Now these salespeople are trying to call them hybrid annuities to mask the bad information that has come out on annuities. Annuities are toxic. They're expense-ridden. They rob your retirement because of the high expenses and surrender fees. Never, ever buy an annuity. That's the bottom line. Michael in Miami, Florida. Are financial advisors independent, or are they required to sell specific products from their investment firms? Most so-called advisors are not independent. In fact, well over 90% of so-called advisors are really stockbrokers or insurance agents that sell products, and they're required, by the way, to sell the products their firms represent or manufacture or sponsor. So when you're working with any of these Wall Street firms, whether they're the smaller broker-dealers or the big ones you hear about on TV all the time, whether you're working with the local bank investment guy, whether you're working with the guy who sells annuities, all of these people sell products their firms represent and are required to sell those products. Again, under suitability, they're not the best products or the cheapest. They could be the most expensive and complete pieces of junk that really hurt your return. Anytime you're working with somebody who's fee-based or commission, these firms, again, are not fee-only. You want to only work with a fee-only firm who makes no remuneration or has any conflicts or any side deals or side bets. They only are paid by you to actually manage their money in a structured portfolio, in a low-cost portfolio that can help benefit your retirement. Remember, your ultimate goal, Michael, is to make money for you, not to line the pockets of Wall Street banks and insurance companies, and not to line a broker who wants to sell you the proverbial bag of goods. Ed in Naples, Florida. We are working with a large brokerage firm. We pay a fee on some accounts. We also have 3 variable annuities. Is this a fee-only arrangement? Ed, it is not. Anytime you're working with any brokerage firm, bank, or insurance company, they are not fee only, and they can never be fee only because they sell and manufacture products. So at the end of the day, you don't want to work with a firm that sells any product. And because you own variable annuities, it tells me you're in a fee-based or commission relationship. Remember, most of these firms do what's called a fee in lieu of commission brokerage account, which again is not a fee-only investment firm, and it's not a fee-only advisory account. Sally in Naples, Florida. I own mostly mutual fund C shares. As you warned earlier in your show, what am I really paying? Is this fee only? Sally, no, you are not in a fee-only relationship. In fact, you're on a brokerage relationship. You own C-share mutual funds, which are the most expensive of any asset class of mutual funds. These things often have an annual expense ratio of about 2 to 2.25% every single year. You're clearly working with a broker. You're not in a managed account. It's not fee only, and you're being robbed by a lot of hidden costs and expense of those actual mutual funds that your broker is required to sell. So you're not in a fee-only relationship. You're in a brokerage account. Anytime you own a mutual fund, and by the way, one of the things I talked about earlier, look at your brokerage statement. If you've ever been sold an annuity, you're working with a broker. If you've ever been sold a non-publicly traded REIT, you're working with a broker. If you own mutual funds, you're probably working with a broker. Most investors, if you look at your portfolio, it's pretty easy to tell if you're working with a broker because you own mutual funds, annuities, you've been sold structured products. You actually might own stock and bonds in that portfolio too that were on a commission basis or a fee in lieu of commission brokerage account. So at the end of the day, again, fee only is substantially different and is what you want, and it's not fee-based and it's not commission. Remember, it's your importance that you research the firm you entrust. Please go to my website, reznywealth.com. That's reznywealth.com. You can download for free our fiduciary versus suitability questionnaire. You can also download for free why annuities are dangerous to your wealth and retirement. Call my firm for a consultation. There is a difference. We invite you to experience it. As I always say, our clients just enjoy retirement. So if you want to take away investment stress, if you want real money management, which includes risk management, please call my firm. We have offices throughout Florida, Naples, Fort Myers, Coral Gables, and Boca Raton. Make sure you have a profitable week. We'll see you next week.